Hey YouTubers, welcome back to my channel. In today's video, I thought I would talk a little bit about the two big announcements that happened earlier on this month. And these two announcements were that Apple announced that they were going to do a stock split of 1 to 4, and Tesla announced that they're also going to do a stock split of 1 to 5. So to put this really simply, if you own one share of Apple, on the 31st of August, you will now own 4 shares of Apple. And likewise with Tesla, if you own one share of Tesla, from the 31st of August, you'll own 5 shares. Now similarly, if you like this video down below, the YouTube algorithm would recommend this video to other people and hopefully I'll get more likes. So head down and hit that like button. Let's dive a little bit deeper into this stock split. First of all, Apple. So, like I mentioned, with the upcoming stock split, basically if you had invested in Apple and bought one share, you're going to end up getting 4 shares. Now, this has no direct financial benefits to you because essentially what Apple are doing is that they're increasing the number of shares in circulation by dividing each share by 4. Therefore, since Apple is trading at around $450 at the time of recording this video, then when the split happens, each one of your 4 new shares will actually only be worth a quarter of $450, which is about $112. So, Apple's board approved the stock split to take place on the 31st of August, which means that shareholders on record as of the 24th of August will be eligible to receive the new shares. But why does Apple want to even do this? Usually, when a company does a stock split, it is because they feel like the stock price is too high, and therefore it deters new investors from wanting to actually invest into the company. Now, because physically, if you only had $100, let's say, to invest, and the stock price for Apple was, let's say, $400, you wouldn't be able to actually buy that one whole share. However, if it was trading at $100, you could. But then again, these days, it's all really a psychological game because most of the newer trading platforms allow you to also buy fractional shares. So essentially with that $100, you could buy a fraction of a share in Apple. But I guess at the end of the day, would you rather have a quarter of a share of Apple, or would you like to have a whole share? Now, this whole concept is nothing new for Apple. Previously, they've actually had 4 stock splits. In the first 3 instances, the stocks were split in 2. And basically what they were trying to do was keep the shares of Apple below $100. Then, in 2014, there was a huge spike in the share price of Apple. And then, at this point, they decided to do a 1 to 7 split ratio. Now, like I mentioned before, the stock split is essentially done to encourage more investment, but the split by itself doesn't actually affect the market capitalization of the company. And essentially, as an existing shareholder, you will still own the same value of the company, but each stock that you would own is just worth less. So, like I said, the split itself doesn't specifically increase the value of the company. However, the after effects usually do end up pushing the company's value up. And this basically happens due to the fact that the split makes the share more accessible to investors, therefore increasing the demand. This then in turn causes the share price to increase. And this is quite evident with Apple, because since Apple's last split, they've become the first ever publicly listed company to be valued at more than $1 trillion. And this was back in December 2019. But then in June 2020, they actually hit the $1.5 trillion mark. And also due to this weird world that we're living in right now with this pandemic, and also the fact that tech companies are doing extremely well, Apple is very close to the $2 trillion mark. So let's take a look at this graph. In this graph, we can see the points at which Apple have done their splits in the past. Okay, now let's say I bought a share in Apple in January 2005, where it was trading at around $77. and then Apple did a 2-for-1 stock split a month later, I would then own 2 shares, but it'll be valued at $38.50. Now, if I keep hold of these 2 stocks until May 2014, then these 2 shares would have increased in value to $633 each. Then there's a 7-to-1 split, which would have left me owning 14 shares of Apple, which would then mean that they're all worth around $90 each. And then over the course of the last 6 years, this would have then increased today to the value of $450, which means that for each share that I would have had, which is 14 shares, would have now increased value to $450, which gives me a total of $6,300. Now that's $6,300 from just investing $77 15 years ago. Not bad, right? Okay, so now let's take this back even further. Now, if you managed to buy a share in Apple during their IPO, they were trading at $22 a share. Due to all of the stock splits, you would now have 56 shares. And then from 1980, when Apple hit the stock market and you would have invested $22, that $22 today would be worth $25,200, which essentially is a return of 114,545%. And that's before inflation and not taking into consideration any of the dividend payouts that's also happened over these years. But buying stocks in a company just because they're going through a stock split is not the best method of investing. Simply because there is no guarantee that the stock price will actually continue to increase, especially during these unprecedented times when no one really understands what is actually going on. Because at the end of the day, we do live in a very different world than we used to live in. So previous trends are starting to make it very hard to predict what is actually going to happen in the future. Now, everyone who knows me knows that I'm an Apple fanboy, and a few years back, I took the plunge and I switched over from the iPhone to the Google Pixel. And this was purely because I felt that Apple wasn't really innovating in the mobile world with the money that they had. And I mean, they definitely have a lot of money, because coming into 2020, Apple was sitting on a cash pile of almost $250 billion. So with that kind of money, they have lots of opportunities to grow the company in various ways. Whether they do it or not, I guess it's all down to Tim Cook. So moving on to Tesla. Now last week, they also announced a stock split. However, instead of a stock split of 1-to-4 like Apple, they announced a 1-to-5 split. Now, anyone who has been following the stock market in the last year will know how well Tesla has actually been doing. Their stock price has skyrocketed from about $200 from last year to being around $1,650 right now. And even a few months ago, Elon Musk even tweeted that he thinks that Tesla stock is too high in his opinion, which now we can probably deduce that this was probably about the time when him and the board started to discuss the idea of doing a stock split. And I guess the reasons are going to be very similar to the reasons that we mentioned for Apple. It makes the psychological factor that the company is worth it for the price that you pay per share, when the share value is lower rather than higher. Therefore, come August 31st, anyone who owns a share in Tesla, which is currently valued at about $1,650, will then own 5 shares of Tesla, being worth around about $330 instead. Now, just like Apple, the stock split by itself will do nothing towards Tesla's market value. But just like we have seen in previous stock splits from Apple, there is a chance that Tesla may have a small spike due to the increased demand of the stock at that lower price. But also, with a lot of innovation and growth happening at Tesla, there is a strong chance in my eyes that Tesla will continue to go up in value. But as it stands right now, Tesla on paper is still overvalued, because with a market capitalization of $307 billion at the time of filming this video, in order to actually be worth that much, Tesla needs to continually grow the number of cars it delivers at a rapid rate over the next 10 years. And as much as Tesla has shown that if anyone's going to be able to do that, it would be Tesla, there are still so many factors that could cause a very bumpy road for Tesla over the next 10 years in order to achieve that. And nevertheless, I personally love Tesla as a company, and also the level of innovation that they have disrupting the automotive world. Therefore, they are definitely a stock that I would like to hold and probably increase how much I invest in them. But I definitely will not put all my eggs into Tesla, as I still feel that it's a very risky investment and it has just as much chance to go up in value than it has to go down in value too. Now, with everything said and done, I always tell you that I have no financial background whatsoever. And all the information that I do tell you in this video is just the information that I've found on the internet while I've been doing my own research into the companies. And if you feel like buying shares from anything that I say, I'll always recommend seeking financial advice from a professional, and always do your own due diligence before investing into anything. But on that note, I hope you enjoyed today's video, and make sure you've subscribed to my channel, and remember to hit the bell button so you get notified when my next video comes out. And always like, share and comment so that the YouTube algorithm recommends this video to other people that don't know about my channel yet. Thanks for watching, and I'll see you again in the next video. Bye.